My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make a little money. My job, not just to entertain, but to educate, to teach you. So call me at 1-800-743-CBC. Tweet me at Jim Cramer. You know why this market just won't broaden out beyond a few gigantic tech names like NVIDIA, Microsoft, or Alphabet? I'll tell you why. Pool Corp. That's why. Yeah, I blame it all on Pool, a company that sounds exactly like what it is. A business that caters to building, fixing, and maintaining everything pool-related. Swimming, not that kind. See, last night, Pool Corp revealed that it's drowning in the deep end with a horrible decline in its business. And it caused a stunning ripple of pain.
The house of pain.
Through vast swaths of the market today. Dow tumbling 299 points. S&P advancing 0.39%. But the tech-heavy NASDAQ with less pool exposure and more AI leverage still jumped 1.26%. Now, unless you own a pool, you may not know Pool Corp. But if you own any stock related to housing in any way, today was probably one of the most horrendous days you've had in 2024. Because the now infamous Pool Corp suggests that its data says there will be, quote, persistently weak demand for new pool construction, end quote, and activity could be down 15 to 20% for the year. See, it's not just new construction. Remodel activity for pools could be down as much as 15%. Bad enough? Pool went very, very deep into the deep end and blamed the consumer. She isn't spending on discretionary goods, including big-ticket items like swimming pools or outdoor living projects. That's why the building materials portion of the business was down 11%. So on the strength, or more accurately, the weakness of the Pool Corp outfit, we saw sharp sell-offs in anything that's even remotely related to a house. That could be Lowe's or Home Depot or Tractor Supply, Builders First Source, companies like Fortune Brands, Masco, Mohawk, fixtures, cabinets, carpet. They all got pulverized today. Look, frankly, I haven't cared for Pool Corp in ages, other than to suggest that it might be tough to build a new pool in California during one of those periodic droughts where they have to limit the water supply. Always bad for pool business. But is it right for the company to blame the consumer? Have the people really reined in their discretionary spending? I mean, geez, Carnival, the cruise line company, reported a record-breaking set of numbers today. And what could be more discretionary than a cruise? More importantly, though, it's clearly hard to figure out what the consumer's interested in or what she's willing to spend on. And you know what? Because of that in a nutshell is why I like stocks like NVIDIA. It's why I come out here almost every night for the last, 5 years and recommend these mega cap tech plays. It's why I created FANG, for heaven's sake. It's why I don't care one whit about whether this market really broadens out or not. What am I supposed to do? Avoid the stock market's winners until we all start buying pools? Oh, that makes sense. Yeah, we should put all of our stock picking in the hands of pool aficionados. Should we just ignore it when we get incredible pullbacks in enterprise-oriented tech companies like NVIDIA because of pool? Look, many people who spout about the market have a very different philosophy from me. I'm always trying to find, for you, the stocks of good companies that are doing great things and can continue to do great things regardless of the cash-strapped consumer or the homeowner who stopped renovating or the swimming pool that doesn't get built. On the other hand, I'm not drawn at all to stocks that may work or may not work if some Federal Reserve official says they may or may not cut rates. That puts me in a position where I have to tell you to own, not trade, but own some stocks that may at times move too high. As you could argue that NVIDIA just did, or that Microsoft has done, or that Alphabet has done, or that Amazon has done, or Apple has done. I own them for the charitable trust because while I like to see I would love to see the market broaden out. I'm not going to help broaden it out myself with my charitable trust money. I'm not going to go into areas that are dependent on, say, the consumer, only to find out the consumer doesn't want that new pool or anything that can help build it. With NVIDIA, yes, the once glorious, now ridiculed as part of some bubble NVIDIA that holds its annual shareholder meeting tomorrow, I don't have to worry about whether the consumer's looking out the back window and say, to build or to not build a pool? That is the question. Don't ask me to divine Hamlet's next darn move, darn it. Don't make me figure out what Hamlet will do if the Fed cuts rates or not. I mean, come on. Cheaper mortgages may not even create more demand for houses, or could, but who knows? All we know is it won't build more houses. You could cut mortgage rates to 5%, and the people with 3% mortgages still don't want to sell. Worse, I could sit here all day and listen to every single one of these Babbitt-type Fed chieftains, what they have to say, because they obviously love the microphone in their gas bags. All the Fed's just a stage now, and these men and women are merely players. They have their axis and their interests, and one man, Jay Powell, plays the only part that really matters. So I say thanks, Shakespeare, and who cares about these subalterns anyway? What the heck does this have to do with NVIDIA? Okay, let's call it the anti-Pool Corp. It's certainly bigger than Pool Corp. Consider the customers of Pool versus the customers of NVIDIA. Pool Corp's customers have no idea if they should put up a pool to increase the value of their home because they can't find another house to move into anyway. The Pool customer is strapped. The Pool customer is mercurial. The Pool customer might just prefer to swim in a pool on a Carnival cruise. The Pool customer is probably worried about interest rates because, well, she might need a home equity loan to build a pool. But how about NVIDIA? How about its customers? How about Amazon, Alphabet, and Microsoft? Perhaps 3 of the 4 richest companies in the world. Do these mega cap worries, do they look like they're worried about interest rates? Last I looked, companies that can pay cash don't worry about interest rates. They aren't all that concerned about the Cleveland Fed or the Minneapolis Fed or any of the other regional Feds like St. Louis or Philly any more than they probably care about the ice hockey teams that from those same cities. No, check that. The execs at these companies probably care more about the ice hockey teams than the Fed officials because they can't buy the Fed officials, but they can buy the hockey team. Is the NVIDIA customer mercurial? Can the customer walk away from NVIDIA like a homeowner walks away from a Pool Corp deal? Are you kidding? If any one of these companies doesn't buy NVIDIA's chips, the other guy will take everything that customer is going to lose. If Amazon today were to walk away and say, you know what? We're going to make our own chips. I think they'd end up falling so far behind in cloud infrastructure that their clients would clearly migrate to Microsoft Azure or Google Cloud in a heartbeat. They can't wait for Amazon to have a competitive chip. That'll kill their business. In other words, as crazy as it seems after its recent decline, I think it's easier to own, not trade, but own the stock of NVIDIA than it is to own shares in any of the companies that depend on the fickle, feckless, torn, strapped, beleaguered, mercurial, arbitrary, confused, and clueless consumer. If you trade it, you end up missing terrific rebounds like today. See, that's what today was about. Bottom line, to put things straight, I'm not going into the deep end to please those who want to market with better breadth and greater participation. Go buy some Listerine. I'm simply going to stick with the stocks of the best companies in the market and tell you about them. And you know what? If that leads me, heaven forbid, to NVIDIA, then so be it. Robert in New York. Robert.
Hey, Jim, I got to tell you, I love calling your show. I think you're so awesome. I ran out of a steakhouse just now. I'm with my friends to call you because you give me the best advice I've ever had in my life.
Are you having the cowboy or are you going for the tomahawk?
I'm actually having the porterhouse, and I'm trying to watch my weight.
You split it with somebody else, right? Or do you have a doggy bag?
Well, I'm going to probably eat the whole thing.
Okay, Lily, table 1 here. Okay.
Jim, I got to tell you, you brought up a very good point about 4 or 5 days ago when you told everybody, listen, it's easy to make money on the way up, but you got to pull some money off the table, and you're right on the mark. Because it is easy to make it on the way up. It's the concern. It's the guy.
Well, everybody's a genius on the way up. Everyone tells me what an idiot I am because they own the triple X-ray Z by the Google Nasty Pie. All right,
Jim, that's exactly right.
It's
you just
simple
nailed
GOOG. Yeah.
That's why you are the man. But anyway.
Thank you. Let's
Jim,
make some money.
You're welcome. Based on the current share price of this stock, the company seems to be about undervalued by 28%, with most analysts rating this thing as a buy. And they're doing a ton of business in Macau. So I think the Macau deal is going to definitely boost their revenue. So are you a winner? Is win still a win?
I got to tell you, win is ridiculous. So Jeff Marks and I talk about it constantly. We have our meeting Thursday at 12. This is like, what do we have to do? What are they doing wrong? And the answer is they are connected in any way, shape, or form to China, then that this is exactly how they act. And Win is a great company doing incredibly well. We're not going to have any takeovers because the FTC would block it. But I've got to tell you, this stock is way too cheap. I'm not going to walk away from it, even though I do believe it is going to 85 before it goes to 100. And that's what I think of Win. If you think I'm going to dive headfirst into a stock like Pool to please those who want a broader market, do not hold your bad breath. I'm simply going to keep treading water with the stocks of the best companies. Hey, companies like NVIDIA. Hey, by the way, how about a little thank you to Jensen for at the meeting tomorrow, the annual meeting? No, you don't care, right? Because you're thinking about the next big thing, or like uranium. On Mad Money tonight, the consumer discretionary stocks that are working are giving consumers a good deal. But what about investors? I'm detailing one of them. got kind of fired up there. That is favorite news. The humanization of pets has been on the back burner for a while, but I think Fido could make you a fortune. I'll tell you why. And of course, yeah, we learned that the EU is charging Microsoft on antitrust violations for bundling Microsoft Teams with its other offerings. It's just another ho-hum, yawning, whatever. No. And I got to tell you, I'm bringing Octa on to try to figure out what's really going on. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Look, this year's gotten real ugly for retail as a whole. But when retail struggles, there are some stories that make out like bandits. Which brings me to Cramer fave Ollie's Bargain Outlet Holdings. That's the off-price retailer that acquires product that other stores or consumer products companies themselves simply can't sell for ultra-low prices and then flips them to you, the consumer. Ollie's is a little like TJX, which is a club holding. We'll talk about that at the Thursday meeting. Ross stores, Burlington stores. Except let's focus on apparel. More exposure to general merchandise. For ages, this was one of my favorite stocks. As an enlisted member of Ollie's Army, that's what they call the loyalty program, I totally understood the value proposition, and I pushed the stock aggressively. I love the place so much that I thought I might be promoted beyond my lowly private status, given the amount of business I was doing at my local Quakertown, PA store. But then tragedy struck. In late 2019, Ollie's co-founder and CEO, Mark Butler, the architect of the company's regional to national growth story, as well as, I got to tell you, one of the most charitable people I have ever met in business, suddenly died. After that, the stock was all over the place. There was a big sell-off when the pandemic began in 2020, quick recovery, and then a hideous meltdown through 2021 through early 2022. Stock tumbled nearly 70% peak to trough. Largely because we had supply shortages all over the place. Ollie's can't get the inventory it needs when regular retailers don't have anything left over to sell. Since then, though, the stock's been steadily working its way back. After the supply chain crisis ended and inventory levels normalized, Ollie's started getting its hands on quality merchandise again. And the numbers just got better and better. But it's really when retail suffers that these off-price chains do best, which is how Ollie's put up tremendous numbers last year, caused the stock to rally 62%. When the calendar flipped to 2024, the stock spent a few months trading sideways, with investors trying to game what could happen next. Ollie's delivered a solid quarter late March, but the company also rolled out a conservative full-year forecast, so it didn't get much love. You know, conservative forecast, people think, whoa, maybe Ollie's is worried. However, right around when Ollie's was selling off in April, people started worrying about the strength of the consumer. And every time you hear any consumer-related hand-wringing, it should make you want to buy the off-price plays, more than, say, the stock of Pool Corp. This is the kind of environment Ollie's is built for, one where most retailers have too much merchandise and most shoppers are looking for deals. Sure enough, earlier this month, Ollie's reported a fantastic quarter, better than expected same-store sales, up 3%, and also only looking for 2.7%, higher than anticipated revenue, up nearly 11% year-over-year. Great to see double-digit, right? Terrific margins, which translated to an 8-cent earnings beat off a 65-cent basis. That is up 49% from last year. As CEO John Swigert put it, and I'm going to quote, "Our unique business model is delivering exceptional values on the branded merchandise that our customers want and need at prices 20 to 70% below the factory stores. Everybody loves a bargain, and bargain is our middle name," end quote. On top of that, Ollie's management made several upward revisions to its full-year forecast, only 2 months after initially coming out with that forecast. Oh, I love that. How'd they do it? Management first credits growth in the closeout industry as a whole, driven by major consumer retailers that are being supplied by large manufacturers, which are constantly coming out with new and improved products, meaning the retailers who supply Ollie's need the old stuff off their shelves ASAP. Coming into the quarter, I had a feeling that Ollie's might do well, given the weakness we've seen in lower-income consumers. But you know what was the most surprising things about this quarter? Positive surprise. Was the fact that Ollie's seemed to be gaining some traction with higher-income consumers, too. On the conference call, company president Eric Vandervalk noted that, quote, Ollie's is continuing to see a trade down of higher-income consumers, end quote, adding that the sweet spot looks to still be the $100,000 to $150,000 household income range, end quote. Now, that's a bit more affluent than what you'd expect from shoppers at a place like Bargain Outlet built into its name. But listen to me. If you're a member of the Army, like I am, and you look at that weekly flyer that you get, oh man, it's orange and yellow, and it just pops in your email box like blue. And then, you know what? The bargains are palpable. So positively grave dancing like opportunities that you don't say, wait a second, I just had a good year. Why do I need to be seen caught dead in that flea market of a store? You stop worrying about whether anybody sees you there. While some bargain brands have mentioned that they're suffering from a pullback in spending from lower income consumers, that sweet spot range we got from Ollie's management is well above what anyone would realistically consider cash-strapped. Plus, Vandervalk noted that when it comes to the industry as a whole, and I'm quoting again, we're underpenetrated in lower income consumers compared to others, end quote. Though he also added that, quote, our lower income cohort is relatively stable, end quote. Hey, what's not to like about that? All we ever hear about that's unstable. His people are stable. While the off-price industry is growing nicely, management also indicated that, quote, the number of bigger players buying and selling closeouts today is shrinking, end quote. Hey, listen, they've taken advantage of this industry consolidation. They recently won the rights to 11 former 99-cents only stores located in a bankruptcy auction. Management seems excited about these stores, especially because they're paying cheap rent for longer-term leases in key places like Texas. While management said that shrink, which is Wall Street speak for stealing and theft, remains elevated, they also told us that, well, quote, they've hit a little bit of a plateau here, end quote. Ollie's had previously indicated that less than 10% of their stores were contributing to over half of the local total shrink problem. That's kind of like what Five Below thought, by the way. And they've been working to figure out how to handle these problematic locations. Another growth driver, the continued expansion of the Ollie's Army loyalty program. Last quarter, membership increased 7% to 14.2 million members, and these members represented over 80% of the company's total sales in the quarter. And by the way, you get a lot of different. I'm not like trying to get you to list in the Army. It's like, hey, Uncle Ollie wants you, but you do get a lot of benefits if you're a member. Got to keep going, got to keep getting these loyalty numbers up, and I think they can do it because you save so much money. Now, in the wake of that terrific quarter, analysts raised their estimates and price targets across the board. Ollie's initially saw its jump from 82. Before the quarter, it's just over 90. After Ollie pulled back to the mid-80s, it got another boost last Monday when J.P. Morgan analyst Matt Boss upgraded the stock from neutral to overweight. I think Boss is the best retail analyst in the business. So when he points out that Ollie still trades at a discount to its pre-pandemic multiple, even though it seems on track to deliver better growth than we had in 2019, you better believe I take it seriously. So let me give you the bottom line here in this incredibly intriguing story that is so not done. In this new environment where the consumer's under pressure or just wants a good deal and is worried about the swimming pool because it's too expensive, the retailer that can offer you the best bargains are thriving. That includes Ollie's, an old favorite, which got through some tough times before getting back on track last year and now looks primed to keep running. Sure, the stock has had a monster move, up more than 25% over the past month alone, taking Ollie's to the highest level in nearly 3.5 years. Maybe it needs a breather, maybe not. But don't be surprised if this one stays hot, because this moment fits the company perfectly. And as an early Ollie's fan, private in the vast army of cheapskates and frugalists, I got to say, it's good to see the business thriving again. And money's back in for the break.
Coming up, can these stocks take you from the doghouse to the pet house? A few of the best ideas on four legs when we return.
As some of the market's hottest groups take a well-deserved breather, and we find ourselves with more signs of a weakening economy, this might be a good time to own some slowdown stocks. Stocks of companies that will do just fine, even if we descend to very low growth as the Fed battles inflation to the finish line. Notice I didn't say recession, because that's what people who scare you into making the wrong moves will do. I'm not trying to do that. I'm explaining where we are right now, what the zeitgeist is. And that's why tonight I want to circle back to an old Mad Money favorite theme that we had put onto the shelf for a while, frankly, and that's the humanization of pets. For years, people seem to spend ever more money on their cats and dogs, something that went into overdrive during the pandemic. But once the pandemic subsided in the post-COVID era, pet adoptions have slowed dramatically. And elevated pet food prices seem to be one of the first items that got inflation-related pushback. Now, though, I think the post-COVID drought is over. And I like the group again. So let's say if you agree with me or you have pets and you want to try to profit off of the thesis, I'm going to give you one retail play, one veterinary play, and one pet food play that I think work right here, right now. First up is Chewy. Yes, the online store for pet food, pet toys, pet healthcare products, you name it. The stock's caught fire here, and it makes me think that the pet food thesis is back. After roaring during the pandemic, Chewy peaked at $120 in early 2021, and then its growth rate shrank dramatically, and the stock got obliterated, plunging to $14 and change at its lows just 2 months ago. 2 months ago. That's an 88% decline from peak to trough. They usually don't go that much lower unless they're insolvent, and this one isn't. Since then, it's on the move, rebounding just under $30, including a monster move today as the e-commerce cohort came roaring back. I didn't see it coming. I wanted to do this. Wish I'd done this piece yesterday. I'm very sorry. At this point, despite this rally, I think the stock's still interesting, though. This one first came back on my radar when I spoke to Sumit Singh. He's the CEO. It was in December, alongside Chewy's first ever investor day, and it went well. Obviously, the stock wasn't done going down at that point, but I came away feeling impressed by how much the company had matured. Singh pointed out that they get well over 70% of their sales from dependable, recurring auto ship subscription plans. I happen to love the subscription business because it's renewable. It doesn't just fall off a cliff. In other words, Chewy's a lot more reliable than you might expect. I told you at that time, I thought Singh sounded strong and confident. And if you could buy it around $20, you could do well. Sure enough, when the company reported late last month, it delivered a monster earnings beat with a 55% growth year over year, even if its sales were only up 3.1%. On the conference call, management talked about green shoots and new pet ownership for the first time since 2022 and a less promotional environment, which helped boost profitability. In response, the stock jumped 27% the next day. And even though much of that was short covering, Chewy kept running and running and running. As I said, it just closed right below 30. For me, this quarter was indeed a game changer because the earnings are so good. You can make a legitimate case for Chewy's valuation even up here right now. See, the stock's selling for almost 34 times this year's earnings estimates, which sounds expensive, but listen to me. They turn in a couple more earnings beats like the one they just did, those estimates will turn out to be way too low. But even if the estimates are right, Wall Street's looking for 29% earnings growth from Chewy this year, and it's 34 times earnings. It's perfectly reasonable to pay this price for this growth rate. Next, there's Elanco. Oh, man, this is one tempting fate when you talk about this one. This is an animal health company that was spun out of Eli Lilly roughly 6 years ago. Lilly looks like it made the right move. We saw what the rest of Lilly did. Elanco makes treatments for both companion animals and livestock. Just like Chewy, the stock peaked in 2021 and spent the next couple of years going through the meat grinder. It fell 79% from peak to trough before finally finding its floor last summer, although it was that kind of floor. Since then, Elanco's more than doubled from those lows. When we spoke to CEO Jeff Simmons earlier this year, he was really optimistic. He explained that they've got 6 potential blockbuster veterinary treatments in the pipeline that are set to come out in the next 2 years. That includes a monoclonal antibody drug for parvovirus. Sorry, I don't know how to pronounce that, but fortunately our dogs don't have it. It's usually lethal if left untreated. I don't want my dogs to get it. He's also got a pill for cats with diabetes. Big improvement, by the way, over the previous standard carrier, which is 2 insulin shots a day. I used to have 6 cats at one time. And try to stick a syringe into a cat, I can tell you, you're taking your life into your hands. Now, just after we last had Simmons on the show, Elanco was targeted by a sharp activist investor, Ancora Holding, wanted a major shakeup, including a new CEO. Management ultimately made a deal with Simmons keeping his job, but Ancora getting 2 board seats. I like that situation. Look at it. Helpful, hopefully helpful, smart activist in there. Feet to the fire. And hey, Elanco's reported excellent numbers in early May. This was a clean, beat and raised quarter. No real hair on it, sending the stock up nearly 25% in a single session. It's continued to turn higher since. It should. But even after this move, Elanco only trades at 19 times earnings. Not expensive by any stretch of the imagination. Plus, the good news keeps rolling in here. Get this. I love this one. The company got FDA approval for a type of cattle feed that basically makes cows less flatulent. Huge. Hey, come on. Stop joking. Listen, it's actually huge for the environment because cows release so much methane. Something that some urgency under the current president will no doubt, some agency will no doubt say, hey, listen, we got to make every cow take this. Not that they would know the difference. It's so stupid. No, I didn't mean that. I happen to own 2 cows, and they're dumb as plywood, though. Elanco will all right. They're not that bright. Oh, let's leave it at that. I feel bad for them now. Elanco, they don't watch. Elanco will launch next quarter, and I think it's a potential blockbuster. I'm telling you, my cow's going to take that methane pill immediately. So if you haven't been keeping up with this one, it's worth another look. Finally, there's J.M. Smucker, which does not have a methane pill. It's primarily known as a packaged foods play, with way too much snack exposure after last year's ill-timed Hostess acquisition. The stock got crushed last fall and hasn't really recovered, especially because everyone's so worried about the GLP-1 weight loss drugs. In fact, Smucker was making new lows as recently as a month ago. However, this company's also got a major pet food business, one that has been intentionally rationalizing recently, selling a bunch of non-core brands to Post for $1.2 billion last year. Good riddance. As a result, Smucker's left with a much smaller pet food division that's all about big-name brands. Milk-Bone, Pupperoni. I once ate a Pupperoni on the set in the show's first year, and I got sick, and we had to stop doing the show for half hours. I threw up, and now I'm back. Meow Mix too. And this streamlined pet food operation feels like a much better business. In Smucker's most recent quarter, the pet food sales grew by 11% when you back out the impact of the brands they sold to Post. Meanwhile, their pet food profit margins soared. So if you want a pet food play, maybe hold your nose and buy Smucker. Do not eat the pepperoni. Betting it can offset the expected weakness in snacks. I wish I'd give you a play here, but Fresh Pets had an insane rally. That's way too high. Every other major pet food brand belongs to another one of these big packaged food companies, a conglomerate, General Mills, Colgate, Nestle. I'm going with Smucker because of the distinctive shrink to grow, more profitably lucrative narrative in pet food. Plus, I think this is a good moment to own a defensive consumer packaged goods name because the market's gotten a little more difficult. Smucker's currently coming off a solid quarter, even as the stock remains near its 52-week low. By the way, while everybody's so worried about the snack division, Smucker's slimmed down pet food business just did $452 million in sales. Hey, that's sweet baked snacks. They only did $337 million. Those pet food margins are substantially higher, too. Should be more of a needle mover going forward. So here's the bottom line. In a tougher market, we need secular trends that can triumph in any economy, which is why I am circling indeed back after absence for a long time to the pet trade. Chewy and Elanco are already on fire, but if you want a direct pet food play, I'm feeling darn right optimistic about J.M. Smucker. And again, stay away from the methane pills unless you're a cow. Let's go to Reg in Georgia. Reg.
Hey, Jim. Great to be with you today.
Thank you, Reg. What's going on?
I've owned PepsiCo since it was Lay's potato chips in Atlanta. It's a great stock, and I know you like it. But it's been down lately. It's down about 14% from its high. The last few days it's gone up, which is good. But I want to ask the expert what's going on with that stock.
Okay, I think if you look at the relative performance between PepsiCo and Coca-Cola, it says everything you need to know. Coca-Cola is up 8% this year. Okay, let's just figure this out. This is really important. And PepsiCo is down 1.5%. Why is that? Because of what you mentioned. The aforementioned Frito-Lay division is viewed as being something that's going to be in the crosshairs of the GLP-1 drugs. I think they're right. Which is why I think right now that Coca-Cola is a better buy than PepsiCo, even after this differential. Mike in Texas. Mike.
Professor Cramer, good to talk to you again. How you been?
I am good. How about you, Michael?
I'm doing great, man. The sun is shining. Summer's full swing. We are talking about Costco today. Now, Costco is a core holding in my portfolio. I've been really bullish on the stock. It's been on an absolute tear. But over the last week, it kind of pulled back a little bit, and I wanted to get your take on this. Is this a short-term pullback, and I should be looking for an entry point to add to my position? Is there something fundamental going on here, and I should think about
No, it's bad. First of all, Mike, thank you for your conviction in calling me on this. But let me tell you something. You know, I do a lot of work, obviously, with Jeff Marks, my partner with the Charitable Trust, and this stock dropped 100 points, and no one even knew the difference. And you had to be buying. And I think that what we're always doing is we're always looking for a discount to buy Costco. That's the way I've been for the last 20 years. I'm not changing now. When the stock goes down, you buy COST. All right, look, the pet trade can work in almost any economy. And that's why I think it might be time to take Chewy, which has moved up a lot, Elanco, which is still reasonable, and J.M. Smucker, which is really down, out of the doghouse and into the house. Much more made money ahead, including my exclusive with Octa. With holes being poked in the Microsoft cybersecurity story, I'm hearing what Octa makes of its biggest competitor when I sit down with the CEO. Then, as I was getting ready for the Thursday monthly meeting for the investing club that I just mentioned with Jeff Marks, I noticed one important theme when it comes to investing in multinational corporations. I'll reveal what it is and how you should handle these investments. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. This morning, European regulators hit Microsoft with a preliminary ruling that they violated EU antitrust rules by bundling Teams with the more popular software like Office 365. At first, you know what? I didn't really much care. Europe loves going after American tech companies like a honeypot. But then as I read the details, I became more concerned. I'm starting to think that my initial reaction may have been a little too knee-jerk. The Teams application has been an uninvited guest on my computer for years. I've never liked having it shoved down my throat just to use Outlook or Word. And I hate the fact that it always pops up uninvited when I turn the computer on. Of course, in the end, it's not a big deal for me, right? You close Teams, open Zoom, and move on. But what if Microsoft's doing the exact same thing to the enterprise to push its cybersecurity tools? Now, that would be a legitimate problem, especially since Microsoft's widely considered lacking by some cybersecurity experts. They've dropped the ball on some big data breaches. Now, some heavy hitters in the industry officials are becoming more vocal about this issue, including our next guest, Todd McKinnon. He's the co-founder, chairman, and CEO of Octa, which handles identity management, and we've known these guys for years and years and years. So this is really important. Listen up, because this is new to me, and I need to know more. Mr. McKinnon, welcome back to Mad Money.
Thanks for having me, Jim. It's great to be here.
Right, Todd, I've always known you're an honest broker. We've known each other for a very, very long time. I was surprised to learn that that there are issues here that we should be concerned about Microsoft maybe being a little too strong and making it so that customers may not be able to take what's necessarily the best cybersecurity product for them. Now, you do have something in interest, obviously. You have a cybersecurity product. But why don't you just explain to us how the business is transacted right now, and maybe give us what you think would have been a better way if everything would just start fresh and no one have an upper, have an upper position on anybody else.
I think this is a really important discussion, and it's a really important battleground. It really, when I look at it, the battle is between monolithic platforms versus choice and innovation and flexibility. And that choice and innovation and flexibility can benefit customers and users because they get a great meeting experience, like with Zoom, and you mentioned being annoyed with the Teams install on your own computer. Mm-hmm. And that's a big deal. But when you get to the cybersecurity realm, innovation means security. Imagine if someone like CrowdStrike 10 years ago was locked out of innovating and creating the amazing security platform they've created. Imagine if we didn't have something like a Palo Alto Networks to help combat against the threat actors out there today. Imagine if we didn't have something like Octa. I mean, if you rewind the clock back 20 years, you had a program called Active Directory, which was getting old and dated and had a lot of vulnerabilities, and Octa came along and innovated, and now the world is much more secure and much better. But it's more than just security. It's about choice in all these dimensions. What cloud infrastructure are you going to use? Which devices are you going to use? What is the best device? As we move into AR and VR, who's going to build the AR components, and how are you going to get logged in there, and how is that going to be secure? So the stakes are really high, and we come down clearly on the side of independence, neutrality, choice, and innovation.
All right, well, look, I've known Microsoft since 1985. I knew Steve Ballmer's a close friend of mine at college. They've always seemed like smart guys. They have all kinds of money. I saw Brad Smith when he testified, recognized that a leader of Microsoft, that they've made mistakes, but they're going to get better. Why shouldn't I just say, you know what? In Microsoft, I trust?
Well, money is one thing, but I think nothing spurs innovation like competition. It's the American way, right? It's free market. Competition brings out the best in everyone, and I think the more companies are forced to compete and forced to face the threat of disruption by not competing and not innovating and not building better products and not addressing their users or the needs of their users better, that's what's really going to keep everything moving forward. And that's when we talk to our customers, Jim, we see it in our own data. Like if you look at the users of Office 365 in the Octa user base, which is our most used application in our user base, those companies also use Zoom 50% of the time. They also use Google Workspace 48% of the time, and on and on. So they want choice and they want flexibility. And I think really in the ecosystem right now, there's a bifurcation between companies that want to maybe cut cost and scrimp on technology and winnow down to the monolithic platforms, and then there's companies that want to innovate and move forward and build new capabilities and use the best infrastructure and the best security tools. And we're clearly on the side of the latter.
Well, let me ask you, the Cyber Safety Review Board, the CSRB, recently found that Microsoft's security culture was inadequate and needs an overhaul. It did seem to me, when I read through their findings, that perhaps there's a culture that is a software culture, an advisory culture, a culture that's trying to do interesting things with artificial intelligence, and then there's a security culture, and that aren't necessarily, they're not incompatible, but maybe in this particular case, you need a security culture, not the kind of culture I just described that Microsoft has.
Yeah, I think Microsoft is trying to innovate and trying to do things. It's a massive company that's had a lot of amazing products and a lot of successes. But I think when you look at it now, you see signs that maybe they're not as innovative. I mean, think about it, Jim. their entire AI strategy is based on partnering with another company, OpenAI. That would have been unthinkable 20 years ago. So clearly, the innovation and the spur to innovate in that company is not what it once was. And I think that the more we can have competition and choice and flexibility in this dynamic ecosystem of more companies fighting their hardest and striving forward to satisfy the needs of users and supporting these emerging use cases, the better off for all of us.
All right, now I can't ask you to speculate on who's behind what kind of cybersecurity that CDK had, which is the automotive business, which has just been a horrendous hack. But I can ask you this. Do you find, is it your experience that when you see a hack that is like the Commerce Department hack, do you first think to yourself, oh, darn, I bet you they got in through some sort of Microsoft backdoor? Is that just, again, the kind of knee-jerk thing that I had when I first felt that the Europeans were just coming down on one of our companies to try to shake the money tree?
Well, honestly, my first reaction is I look and see if they're an Okta customer and try to help them in any way I can. And even if they're not an Okta customer, I want to help them in any way I can, because these are all horrible. We've had our own issues with our own internal security issues. Microsoft's had their own internal issues. Anytime one of these things happens, my first thought is like, how can we help? And it's horrible for everyone involved. And just how can we make the whole industry more better and more secure and not have to deal with these things? So I think that one thing we know from the data, broadly speaking, is that 8 out of 10 of these attacks are because of an identity-based compromise. So they stole some password, they found some account that wasn't locked down like it should. So I think having better identity security posture across the board, comprehensive view of all your identities, all your logins, control on what the policies are that control when they can be accessed, and trying to monitor and secure that is a big benefit to companies that do it right. And that's why we're working so hard trying to build the best identity security products in the market. And you see it in our results. We're growing nearly 20% a year. Margins are expanding, and so the success is the evidence is kind of in the data.
And you were forward enough to admit that you guys were hacked, and I think it's just look, it's endemic these days. One last question: do you think that bundling per se is anti-competitive? Because I got to tell you, if you talk to Nikesh Arora, and you mentioned Palo Alto, they've got a platformization. I could argue platformization seems like it's bundling. I mean, I don't know. I don't want to be too. Yeah, I don't want to just slam someone because they're bundling. Because I like a bundle sometimes.
Yeah, no, I don't think so. And I don't think bundling is anti-competitive. I think that a lot of times bundling can benefit customers. I mean, we are going to customers and saying we want to bundle identity. We want to be the single supplier for our customers around identity. We think that there's a lot of value in that. You have to have bundles. Companies can't have 2 million vendors. I mean, there have to be points of consolidation and bundling where it makes sense for the customer. I think where you cross the line is where you can't let companies bust out of the bundle. So it's like bundle or nothing. You prohibit choice, or you prevent the natural desire of the customer at the expense of your bundle, and that's what I think is crossing the line.
All right, well, look, Todd, I'm so glad you came on. Obviously, I want to invite Brad Smith from Microsoft on. I did not know this issue well enough, other than to say, you know what, I've got to look deeper. And I'm so glad you came on to Mad Money tonight, and for your wisdom about this issue. It's obviously much bigger. It's happening every day, and we got to figure out what's going on. So I want to thank Todd McKinnon, co-founder, chair, and CEO of Octa. Always great to see you, Todd. And again, Microsoft, you were invited on to talk about this very issue. I'm not trying to shut you out. I've always respected the company, so use position my travel trust. Thank you, Todd.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
That's where calls my partner saying the stock started by myself just when it calls my stock you plan is. And then the lightning round is over. Are you ready, Ski Daddy? The lightning round. Let's start with Pros in California. Pros.
Hey Jim, I just wanted to get your quick thoughts here. What do you think about Hartford Financial, HIG?
Okay, I tend to not like the insurers just because there's so many different variables. I do like Chubb, but this fellow, Chris Swift, who's come in and fixed Hartford, he deserves the premium that the stock is getting, and it can go even higher. Let's go to Christopher in California. Christopher.
Hello. I was wondering what you thought about SMCI stock. I've been buying it.
SMCI is like it's like an NVIDIA I don't know, times 7 or minus 7. It's just too hard. Why not just own NVIDIA? It's less, much less of a black box. Come on, are you kidding me? Alexander in Georgia. Alexander.
Mr. Cramer, it's great to be back on Mad Money for a third time. I'd like to gauge your insight on a company doing a roll-up of landscape supply businesses. The company's called SiteOne Landscape. What are your thoughts?
Well, I tell you, they do a roll-up of a business. They ought to go into the pool business. They should do roll-upping up the pool business. It'll go very well with the landscape business. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, the CNBC Investing Club meeting is Thursday. But this market matter can't wait. Cramer reveals a heavy headwind. Next.
As I get my thoughts in order for Thursday's CNBC Investing Club meeting, I keep finding a common theme. If a company's earnings depend on China in any way, shape, or form, then you better be sure you have everything else buttoned down, because China's not going to surprise the upside here. China's economy is doing poorly, plain and simple. While there'll always be a handful of stocks that can defy the intellectual badness of anything related to China, they tend to be few and far between. Yet somehow there are plenty of people in this country who believe that China is still an economic powerhouse and America is now missing out on some great opportunities. Exhibit A, today, the New York Times ran a piece titled, "Where have all the Chinese IPOs gone?" Aha, when I saw this headline, I breathed a sigh of relief. Finally, we have a journalism outlet that's willing to expose the travesty of Chinese IPOs. The losses from these deals have been so staggering that Wall Street finally put its foot down because the brokers can't afford to keep foisting junk merchandise off on their clients, right? Isn't that the story? But that's not where they went with the article. It's really about how the Chinese have made it difficult to do deals here, not our own brokers standing up for their customers for once. Here's how the Times put it, and I quote, "As the geopolitical relationship between China and the United States has deteriorated, it's become increasingly difficult for Chinese companies to find a foreign market where a listing might not be jeopardized by political scrutiny," end quote. According to the Times, the IPO drought is a product of Xi Jinping's it's his thinking as he drags his economy back towards something resembling communism. And sure, that's one side of the story, but here's the other more relevant, less told story. Chinese companies have trashed our investing public for years now, treating American markets as a feeding trough for feckless companies that should never have been brought public to begin with and should have never been allowed to list here. If you go back to when this decade began and just looked at the 14 Chinese IPOs that were larger than 500 million, you'd be astonished by how horrendously they performed. Here's the top 5. DD Global, kind of Uber on steroids, down 69%. Lufax, fintech lender, down 83%. KE Holdings, a one-stop shop for all real estate company, down 24%. Xiping, an electric vehicle business, off 47%. RLX Technology, a vaping company, down 85%. In fact, only 2 of the IPOs north of 500 million are still up from where they came public. Many, if not most, of the smaller deals have performed far worse. It is a disgrace, people. Don't get me wrong. Things used to be different. A long, long time ago, we got IPOs from China that routinely made you money. Now, though, ever since our relations with China have soured into a new Cold War, well, at least a trade war, well, it's almost as if they've gone out of their way to blast our markets with this nonsense. In fact, I'll go a step further. If you didn't know any better, you could write a story with this headline. Xi, in reversal, will no longer punish American investors with IPOs from horrendous Chinese companies. PRC chief laments the destruction of American life savings because of suboptimal offerings, initiates a pause as he tries to clean up the mess, end quote. Of course, that's not how it happened. I don't care how this fire hose of money losers got plugged. I'm just glad it ended. I only wish it was because of our government or our investment banks standing up for you. But it looks like neither tried to protect the American investing public. I hate to say it, but President Xi did us a big favor by stopping this bilge. Let's just hope it stays that way. I like to say there's always bull market somewhere. I promise you I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.